Will Amazon's stock price reach $5,000? This is a question we are going to try and answer by looking through this piece written here on Seeking Alpha by Gunnar Soysal. And the summary of all that he has written is that Amazon is currently the fastest growing mega cap and has much more room to run based on various growth areas in combination with moderate valuation. COVID-19 led to accelerated growth in the areas of e-commerce and cloud computing, from which Amazon, as the global market leader, should benefit in the long term. Amazon is a necessity from the perspective of consumers and the growth, as well as a value stock from the perspective of investors. Fair value calculation of a DCF method and a comparison with its peer group indicate an upside potential of at least 50%. So this is his introduction. And he said here, I had updated my fair value to 3,348 and indicated an upside potential of 67%. The share price at the time was around $2,000. The current share price is $3,200. Since then, the stock delivered a performance of 62% with a current stock price of $3,200 and with a year-to-date performance of 65%. Amazon is the top performer among mega caps. Okay. So, consequently, and based on the last two quarterly reports, it is time for an update. Let's now take a look at the most recent quarterly results and discuss why the stock has much more room to run. Furthermore, I want to present on what basis I calculated my updated price target of $5,000 per share. And he looked into the quarterly report that was just announced some days ago. Amazon reported revenue of $88.9 billion on a consolidated basis, up 40% year over year. This even smashed the higher end of the company's own guidance of 18 to 28% and surpassed analysts' consensus estimate of $7.62 billion or approximately 10%, which were calling for revenue of around $81 billion. With regard to top-line growth, it can be stated that each of Amazon's segment made a particularly strong contribution to growth. The North America segment grew by 43% year over year to $55.4 billion. The consensus was $50.4 billion. The international segment grew relatively high compared to past quarters to 38%, which is $22.7 billion. It is worth mentioning that the international segment even became profitable, which indicates that the business is becoming increasingly scalable. Considering that the international segment is currently less than half the size of the North American segment, the international segment is still in its infancy and offers plenty of growth potential. AWS, currently the smallest segment by revenue, continue to show a high double-digit rate at 29% to $10.8 billion and slightly missed expectations. The consensus was $11 billion. So, taking into account the global cloud migration, it is still in its infancy despite an accelerated adoption due to COVID-19 and considering Amazon's global leadership in the area of cloud computing. This segment also offers plenty of growth potential. Okay, and then let's enlarge this table so that you can see. And the segment highlights North America 20%, international 12%, AWS 37% consolidated, 20%. So that AWS has the highest. Okay, for this quarter, it wasn't the highest. This quarter, it wasn't the highest. The highest was the highest was international, and net sales, North America. Okay, yes, we're going to include this link for you to read up. And as one of the main drivers of the revenue acceleration, the outbreak of the global pandemic and a related adoption of e-commerce can be seen, which resulted in a disproportionately high revenue growth of online stores and third-party seller services. In this context, the company said that the online grocery sales tripled in the second quarter when compared with the same period last year. It is also worth mentioning that the other revenue group, which primarily comprises advertising revenues, had an extremely stable growth rate of 41%. This indicated that Amazon's advertising business is currently much less vulnerable than the advertising revenue of other mega caps. Okay, let's enlarge this so that you can see. This is a quarter in question here, second quarter of 2020. Online sales up 48%. Physical stores, less, dropped by 13%. Okay. Turning to bottom line, operating income increased to $5.8 billion, up 87% year on year. Net income doubled to $5.2 billion, resulting in an earnings per share of $10.3 and smashing analyst consensus of $8.80, or about 7 times. So, okay. And then let's go down here. We don't have to read everything. He now says the updated price target indicates over 50% upside potential. To determine the further upside potential, I examined and compared the price to sales ratio of different mega caps. As you can see in the figure below, Amazon currently has the lowest price to earnings, so price to shares ratio with 5.4 in the peer group comparison. The forward price per sales ratio is even lower at 4.5. Nevertheless, it should be noted that Amazon, with a revenue growth of 40% in the most recent quarter, shows the highest revenue growth in the peer group comparison. So, but the problem with having this sort of comparison is it just indicates that the person that doing the analysis doesn't have enough tools to do this analysis, because comparing two different companies, as much as they are in the same company, the same market, but they are never absolutely the same. So Amazon has some advantages against some of the other ones. Amazon literally sells staples. So you can call it staples. We need what they sell. Google, Microsoft, they sell what we need, but they don't really sell everything that we need. We can't. We can still do without them, but we really can't do that much without Amazon. So it's not a very wonderful comparison to compare them with the other big caps, So we go on and read on. If the stock were only to narrow the valuation gap to Apple or Alphabet, it would have at least 50 to 55 upside potential, which could respond to a stock price of about $5,000 based on the current share price of around 3,200. Okay. Even a forward price per sales ratio of 7 in the current market environment, and in the light of the valuation of good stocks with PS ratios about 20 would still be a bargain for a stock like Amazon, considering its growth rates and market leadership in various growth areas like e-commerce and cloud computing. With regard to the market cap, it is noticeable that Amazon is ranked just behind Apple with a current market cap of $1.58 trillion. Nevertheless, I expect Amazon to take the pole position soon based on its high double-digit growth rates. Amazon not only impresses with the revenue growth, but also with its free cash flow growth. The company's free cash flow grew by around 28% in the current quarter, despite more than $4 billion COVID-19 related expenses. Those expenses wouldn't hinder a cash flow as such, because cash flow doesn't. The fact that cash is going somewhere else or coming in is cash flow. So whether it's been spent on COVID-19, it doesn't. It's not a negative. It's an addition, because whether cash flow is it's cash flow. As far as money has gone in or out, that's it. So based on the current data, I have decided to calculate an update for my fair value of the DCF method. In order to choose a conservative approach, I have chosen a growth rate of 27% per year, including a growth decline rate of 10% in terms of free cash flow. Since free cash flows have been volatile in the past, in this context, it is noteworthy that according to Market Screener, analysts estimate a free cash flow growth of 52% in the first financial year 2021 and 28% in financial year 2022. Furthermore, I've chosen a multiple of 20 for the last FCF, since I prefer using a conservative approach. This multiple is almost half as high as Amazon's current price per cash flow multiple of 38.8% and far below its 5-year average of 30.3 provided by Morningstar. Based on the discounted cash flow valuation, the fair value is 4,762.53, which corresponds to an undervaluation of about 50%, and a potential market cap of approximately $2.5 trillion. So this is his calculation. And market cap is currently that. Share price is that. Free cash flow in billions is that 1.85 billion. Cash on hand 71.39 billion. Total debt 47.8. Shares outstanding 500 million. What else? Free cash flow. Okay, this is just what is this? Stating his data there. Okay, we will include all of this for you to read up. This link will be in the bottom of the in the description box for you to read up yourself and digest it yourself. Make your own conclusions and opinions. So this is the conclusion. Amazon is one of the biggest beneficiaries of the growing e-commerce sector and has received a major growth boost as a result of the global pandemic and the lockdowns on global level. Okay, so Amazon is a necessity from the perspective of the consumer and should be a core holding in every active investor's portfolio. This applies to growth investors as well as value investors. In the case of Amazon, we're talking about a company which has a revenue growth of 40% and a free cash flow growth rate of approximately 30%, with a trading 12 months revenue of impressive $322 billion and considering its market leadership and growth rates, a bargain forward price to sales ratio of 4.5%, especially compared to its mega cap mega peer groups. In terms of valuation, my updated fair value calculation, the DCF method, indicates a price target of 4,762.53, which corresponds to an undervaluation of the stock of at least 50%. Okay, developments which could put pressure on the stock price are, for example, ongoing antitrust probes, digital tax disputes, investigations in the context of data collection and data security by public authorities all around the globe. I intend to publish my favorite tech stocks in future if you're interested. Okay, so taking these into account, it can be stated that Amazon is a mixture of a growth and a value investment. Last time I wrote about this, it was concerning Facebook when I had dropped to 150 as a result of the Cambridge Analytics scandal. Currently, the stock stands at 253. Based on Amazon's underlying fundamentals and my fair value calculation, any dips in share price could create a buying opportunity for potential investors, which is true. That's the truth. Even if the share price appears fundamentally undervalued, unexpected events are always to be expected in the stock market, and there's no guarantee of a rise in share prices. Investors should always bear in mind that stock prices are volatile and should not be influenced by price movements alone, but rather should pay attention to the underlying fundamentals. In this respect, investors should always pay attention to the individual risk tolerance. Okay. Thank you very much for watching this video, and we will include this link. It is already at the bottom of this video in the description box below, and subscribe to our channel. Sign up on our platform, Equity for Keeps, eq4k.com, and support us on through PayPal and on Patreon. Thank you very much again.